Chetan, I just asked you, what did you make of the Fed's minutes?
Oh yeah, I think the key message we're getting from the Fed is that it's just not watching inflation, it's also watching the financial conditions and financial stability risks. And I think it's sort of also the message across the world from other central bankers as well, from ECB as well as from PBOC. I think this time, after having seen the experience of 2003 to 7, central bankers are also watchful of the fact that they don't want this financial stability risk to emerge. So I think they're trying to balance their mandate and not just look at inflation, which has been somewhat weaker than expected, Rish.
Okay, well, the timing is going to be crucial. Of course, how long is a piece of string? I could really ask you that instead, but it will happen this year, won't it?
Yeah, we do expect the Fed to announce the balance sheet reduction in September and actually take it up in October and then take up another rate hike in December. We are watching, and so is the Fed, we think, watching the sequential trend in inflation. The year-on-year number, as we all know, is now going to be affected by those idiosyncratic factors, particularly the telecom services charge, which has taken off almost 18 basis points of core CPI. But whether the sequential trend also then picks up is what I think the Fed will be watching. And if that kind of supports them, then we will get that December rate hike too. But the balance sheet reduction in October, we think, is almost now, it's a done deal.
Chetan, I just want to throw up a quick chart for our viewers. It's 92.83 on the Bloomberg. It shows essentially these bloated balance sheet from central banks globally, the PBOC, the ECB, the BOE, or rather the BOJ, I should say, on that chart, and the Fed well above all of that. I mean, Janet Yellen has indicated this unwinding is going to be, basically excruciatingly boring, right? Do you think there is a risk of a messy reduction in balance sheets?
Well, we think that actually this will be fine. The markets will be able to take this reduction in balance sheet because the most important framework point that we are watching is the improvement in the private sector confidence. So private sector risk attitudes are back. Remember, all these balance sheets were taken up for expansion at a time when money multipliers were broken. They were very weak, and the central banks had to take up the expansion of their own balance sheet. But what is happening now is almost all the big three G3 economies, which is US, Europe, and Japan, we have seen a pickup in private sector debt growth, and they have stopped deleveraging, which means that now the money multipliers are normalizing. The financial sector is also in a much better shape now than before. So we think this is the time for the central banks to actually pull back that support in form of the balance sheet increase that they were doing. But look, I think at this point of time, the way they are doing in terms of the experience they've had since the tapering that the Fed had done, they're doing it quite carefully, communicating in advance. But that's the key risk to watch, whether they communicate it efficiently or not. And the second thing to watch is the momentum of the private sector. At this point of time, when we look at the data on the real economy in terms of growth, we got the PMI data for US and Europe being strong. We also got PMI data in China to be strong. So we think global growth is holding up okay, and the private sector is holding up okay. So at this point of time, that decision seems simply right one to reduce the balance sheet. The communication will be critical to watch whether they kind of cause any kind of skirmish in the markets.